Hi, I'm Todd Piggott, managing member of the Zinc Income Fund. If you've ever looked at private lending or private lending opportunity, you've probably heard about returns of 8, 9, sometimes 10%. And while returns are important, that's not the number you should focus on first. The number that really matters is the one that determines how safe your investment is, called the loan to value ratio, or LTV. Let's break it down. LTV measures how much we're lending compared to what the property is actually worth. So if we lend $650,000 on a property and it's worth $1 million, say in Southern California region, that's a 65% loan to value. That 35% difference is your protection and my protection. That's the equity buffer that stands between your money and potential loss. At Zinc, our average fund LTV is about 65%, sometimes even lower depending on the project, because there's value add with the projects that we lend on. 65% is extremely safe. Why? Because we're very conservative by design. You have to understand, my money is fully deployed in the fund as well. We want to make sure that even if something unexpected happens, and there's a default by the borrower, or if the market dips slightly, if the property needs work, there's enough equity in that deal to keep our investors protected. Think of LTV as your airbag. You don't want to test it, but it's there if something goes wrong. I've been in this business for over 2 decades. I started in 1996. I've seen lenders or borrowers chase higher returns by pushing their LTVs, lending up to 80, 85, 90%, because they wanted to do more loans. And that works great when the market's hot and there's heavy appreciation. But when things tighten and get more into neutrality, which is where we're at now, and the market starts to slow, when value's correct, that's when problems can start, because there's no cushion left. That's why our investors sleep very well in our fund, because we don't lend at the edge of risk. We lend where the math works in our favor. Our average LTV in our fund is 65%. In very desirable areas, I call it the absorption rate, where the absorption of real estate is very favorable. Let's say we fund a loan for a home worth $500,000 and we lend $325,000. That's 65% LTV. Now, even if the prices drop 20% or 10%, whatever, that home is still worth $400,000, well above our loan balance. We can recover, we can extract, and we can resell, because our loans are only 9 months. So protection of principal is there. That's what disciplined underwriting looks like. LTV is also a reflection of who we lend to. We're not working with borrowers who are desperate for cash or doing cash out refis or over leveraged. Our borrowers are professional real estate investors, people flipping homes, improving homes, typically with very strong credit. Our average FICO is 710, and they have excellent experience. They're in it to make a profit. They're actually making money, and they've got their own money in the deal as well. We refuse to do a transaction where they're not cash alignment of interest with us. They have what I call skin in the game. When they've invested their own capital, they fight to protect it. That means your investment and my investment through the fund is even safer. So if you're comparing, if you're looking around and comparing investment options, here's my advice. Don't just ask, what's the return? Ask, what's the LTV? What's the credit tier? Because in private lending, returns are what you earn, but LTV is what keeps you in the game and keeps your principal protected. I'm Todd Piggott, managing member of the Zinc Income Fund right here in Fresno, California. Hundreds of millions of dollars in loans originated right here. If you'd like to learn more or make a new friend, give me a call right here at the office. Click the link below. Thanks for watching.